Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. We have a few big developments to cover today. Today's episode will also contain this month's first sponsored feature. Sponsored features are limited to just 2 long-form features per month to ensure that the channel is financially sustainable while reducing the disruption to the viewer experience. I am very excited about today's sponsored feature. Of all the companies I work with, this is the one that I'm most bullish on. We'll touch on that later in today's episode. But first up, we begin today in Asia. Across Southeast Asia, the once sturdy link between middle-class aspirations and home ownership is fraying. From Kuala Lumpur to Ho Chi Minh City, soaring property prices and stagnating incomes have left urban residents confronting a stark reality. The dream of owning a house is increasingly out of reach. The problem is not limited to rising prices. Housing affordability has become a macroeconomic challenge that threatens consumer spending, financial stability, and long-term growth. Economists warn that when home ownership shifts from being an attainable goal to an elite privilege, the effects ripple well beyond the property market. In Malaysia, the mismatch between wages and housing costs is glaring. Average monthly salaries of around $1,800 make saving for down payments difficult. Yet the number of transactions is falling, highlighting a skew toward luxury purchases. A single $3.4 million residence managed by Four Seasons was included in this year's sales data, an outlier that underscores how demand at the high end distorts overall figures. Vietnam tells a similar story. In Hanoi, condominium prices have surged 87% in 6 years, while transaction volumes have dropped sharply. The cost of an apartment now averages $2,900 per square meter in Ho Chi Minh City, levels far beyond the reach of most wage earners. Analysts say this signals a dangerous two-tier system in which the wealthy and foreign investors drive demand while ordinary citizens are priced out. Regional studies point to the scale of the affordability gap. The Asia Development Bank and other institutions estimate average price-to-income ratios in major Asian cities at 12.5 or higher, compared with the international benchmark of 3 to 5, which is considered affordable. In Jakarta, that figure is nearly 19, one of the highest in the region in the world. Such distortions are reshaping economies. When large segments of the population abandon the goal of ownership, banks issue fewer loans, consumption slows, and the property sector, long a driver of growth, becomes reliant on speculative demand. Economists caution that this imbalance risks creating instability if the luxury segment falters, leaving unsold inventory and declining prices. For now, the gap between aspiration and affordability continues to widen. Unless governments intervene with measures to expand affordable housing, regulate speculative practices, and encourage viable rental alternatives, Southeast Asia's housing crunch could entrench inequality and dampen the region's economic momentum for years to come. And of course, these are the type of economic issues that can very quickly transform into political ones. Next up, the race to dominate artificial intelligence is reshaping the stock market, driving an unprecedented wedge between the performance of mega-cap technology firms and their smaller counterparts. A US-based Bloomberg measure shows smaller tech shares trailing large-cap peers by the widest margin in 3 decades. Microsoft Corp and Nvidia Corp have climbed 24% and 36% this year to date, respectively, powering the large-cap tech index up 16%. In stark contrast, the small-cap technology index has slipped 1%. While big tech's market leadership is hardly new, the extent of this dominance has deepened as AI spending surges. Quote, "There are certain resources that are needed for outperformance, and that's why the large caps are doing so much better. All the investment they make, all the power they have, that all translates to results and performance," end quote, said Dina Ting, head of Global Index Portfolio Management at Franklin Templeton, adding, quote, "Small and mid-caps just don't have the ability or excess capital to compete," end quote. The disparity is evident in the numbers. Microsoft alone is projected to pour $86 billion into capital expenditures in its 2026 fiscal year, nearly half the size of the entire $180 billion market capitalization of the small cap technology index. Smaller AI firms that could help diversify the field often remain private, keeping them out of reach for small cap investors. Design software maker Figma Inc., for instance, delayed its public listing until it was valued at large cap levels. Quote, "The reason small cap technology outperforms is we simply don't have enough AI in small cap," end quote, said a small and mid cap equity strategist at Jefferies, speaking to UK-based Reuters, adding, quote, "And the AI we do have, it is very hard for them to compete because they're too small." End quote. Meanwhile, the disruption AI poses is hitting some small tech businesses directly. Wix.com, very vulnerable to AI-driven alternatives, has seen its shares plunge 44%. Other niche firms such as C3.ai Inc. and BigBear.ai Holdings Inc. have tumbled after disappointing earnings. By contrast, megacaps and emerging giants like DeFi Technologies Inc. have delivered robust results, helping investors look past lofty valuations. This earnings season, 91% of large-cap technology companies bet profit expectations, compared with 77% for small-cap peers. For smaller firms, hopes rest on a narrowing of the growth gap. One small-cap investor, speaking to UK-based The Financial Times, expressed, quote, "The market pays for growth, and the growth you see at large-cap tech is just that much better. We're hoping for good times ahead, but we have been for a long time now." End quote. One of the most interesting and controversial developments in finance in recent years has been the rise of digital assets, especially now that the US administration is embracing crypto. Many traditional investors are increasingly interested in having some exposure to digital assets in the higher risk, high return part of their portfolio. However, they want to do so through holding traditional stock assets rather than dealing with holding digital assets themselves. There is also demand for a diversified holding of these assets. Today's video sponsor, DeFi Technologies, listed on the Nasdaq as DEFT, provides an attractive way for investors to do just that. DeFi Technologies is a financial technology company that allows traditional investors to gain exposure to a diversified portfolio of digital assets across the decentralized finance and Web3 sector. I've worked with DeFi Technologies as a sponsor for well over a year now. Indeed, since my first featuring of DeFi Technologies in June of last year, the stock for their company has surged over 150% and graduated to the Nasdaq. I have and continue to be super bullish on this company. Indeed, the stock has outperformed even Bitcoin for years. Look here, 1 year performance, Bitcoin 76%, DeFi 122%. 2 year performance, Bitcoin 238%, DeFi 3,474%. How has DeFi Technologies been able to achieve this? DeFi Tech is a portable business that grows globally with the continuous adoption of decentralized finance and crypto assets. The crown jewel business is the company's subsidiary Valor, which creates and issues ETPs, exchange traded products, for the cryptocurrency sector. As this image shows, at the end of May 2025, Valor had $800 million under management. Valor offers over 75 exchange traded products, ETPs, covering the full spectrum of the crypto market. This is the model that makes it so profitable. The ability to provide institutions who are barred from their forming documents from owning cryptocurrencies outright, but are 100% eligible to own ETPs. Even after reporting record revenues this past quarter, and even after surging more than 250% in the past year, the company still trades at a trailing price-to-earnings ratio of under 10. Another department that is under Valor engages in staking and lending, and this helps to generate approximately 8% on AUM that is stacked or loaned. The Trump administration has taken significant steps to reshape US cryptocurrency policy, and DeFi Technologies management has taken notice and made an acquisition recently that gives it US exposure, while it continues on its global expansion plans, as you can see here. As Valor's parent company, DeFi Technologies is the largest institutional asset manager of Solana in North America. DeFi Technologies earns an 8.5% yield on stacked Solana, generating up to $33 million in annualized revenue based on current asset prices, more than any other asset manager or public Solana holder globally. DeFi Alpha is another business department that has been a resounding success for the company. The trading desk has generated about $100 million in the first year, and these funds are retained in the company's balance sheet. Since the company graduated to the Nasdaq, several analysts have begun covering, along with those that issued reports on the company in the months leading up to that moment. You can request that they send these reports to you. By emailing the analysts, you can see how they think about all things DeFi tech. What's more, DeFi Technologies is one of only 3 profitable public crypto companies. They just had a record quarter and their projected revenue for 2025 is over $200 million. Founder of DeFi Tech, Olivia Newton, owns 17.9 million shares, which are worth over $50 million. Newton has been in this industry since 2010, making him one of the most experienced crypto entrepreneurs on the planet today. So you have a company with a solid foundation, with a low price to earnings ratio, an explosive industry, a friendly administration, and an experienced leadership putting their money where their mouth is. This sort of move is a speculative opportunity. Higher risk, but also high reward. DeFi is a company worth looking into and doing your due diligence on. This is a sponsored feature. It is not individual investment advice. Relevant disclosures, including more information on this company, are in the description below. Thank you so much once again to DeFi Technologies for sponsoring this episode of Market Update. We now return to regular coverage. The European Union is pushing to shield its landmark digital regulations from being targeted by Washington, as Brussels and the Trump administration struggle to finalize the wording of a long-delayed joint statement on their new trade deal. The communique, originally expected within days of the 27th of July agreement, announced by European Commission President Ursula von der Leyen and US President Donald Trump in Scotland, remains stuck in dispute. EU officials say language on non-tariff barriers has emerged as a sticking point, with Washington pressing for flexibility that could allow future concessions on the bloc's Digital Services Act, DSA. The DSA forces major technology platforms to more aggressively police illegal and harmful content, a standard the Commission views as non-negotiable. Quote, relaxing these rules is a red line, end quote, one official said, but a US counterpart countered that digital trade restrictions remain a top concern. Quote, we continue to address digital trade barriers in conversations with our trading partners, and the EU agreed to address these barriers when our initial agreement was struck, end quote, said one US official speaking to US-based Politico. The deadlock has also stalled progress on tariffs. Brussels had expected Trump to follow through on a commitment to cut duties on EU car exports from 27.5% by 15% by the 15th of August. A US official, however, said such action under Section 232 would only follow once the joint statement is concluded. The delay contrasts with Washington's handling of its so-called economic prosperity deal with the UK, whose terms were published the same day that it was signed in May. The EU-US pact sets a ceiling of 15% on most EU goods exported to the United States, with exemptions for some sectors including aircraft parts, pharmaceuticals, and critical minerals. Yet analysts across Europe have criticized the deal as lopsided, noting that Brussels accepted higher tariffs while pledging to boost purchases of American energy and investments in the US economy. Further complications have arisen over timelines for improved US access to the EU market, covering goods from fish and cocoa to industrial exports. EU officials insist such changes must follow internal approval procedures and that sequencing matters. Quote, we made political commitments, which we intend to honour, provided they, the US, do the same first. End quote. With pressure mounting, a Commission spokesperson over the weekend said that the drafts are still under review in Brussels, explaining, quote, we are fully focused on getting to that joint statement. The last mile is always the hardest. End quote. Okay, that is today's episode of Market Update. If you got some value from today's episode, don't forget to hit the like button and consider subscribing so you have more up-to-date analysis on the biggest updates around the world for future episodes. Thank you so much for watching. Have a great Monday, have a productive week, and I will see you for a new update tomorrow.